So Nike's gotten beat up kind of a lot recently, I think for pretty good reasons. Over the last 5 years, Nike's gone from a $280 billion market cap company to under $100 billion. So they've lost 70% of their value over the last couple of years. Revenues are not doing great. That being said, their price to earnings ratio has also kind of halved. We went from 85 to 37. There's a whole big mess. So what happened? Nike announced in 2020 that they were going to get a new CEO. Nike replaced their longtime CEO, Mark Parker, who had been CEO since 2006. By the way, there's only ever been like 4 CEOs of Nike. And then John Donahoe came in. Mr. Donahoe, he was kind of the worst thing that ever happened to Nike. So one of the big things that Nike prided itself on was its sort of cultural relevance. But what unfortunately happened was Nike started to see a little bit of bloat happening. There were high costs. There were probably more employees than maybe necessary. And also, we were heading into 2020. 2020 was kind of a big year for the whole digital space. And so what Nike decided to do was, hey, let's bring in a digital first CEO. And so John Donahoe is definitely that guy. He worked for Bain Capital for a while in the 90s. If you don't know anything about Bain & Co., private equity, they like to, you know what they do. They cut costs, and they cut costs hard. Eventually, he became the CEO of eBay, which honestly, his tenure at eBay worked out pretty well. He was able to cut costs and drive revenue growth. The whole digital transformation worked great at eBay. And then he went to ServiceNow, which again, ServiceNow is an entirely internet native platform. His tenure at ServiceNow saw massive growth in the stock price, right? So 2016 to 2020, he did great. The stock is up 500% over his tenure. He did great. ServiceNow is a software company. They do cloud computing. Dude comes in, he has one job: cut costs. The problem is, this does not work for Nike. Nike is not a digital platform company. The board of directors thought they could be. Nike fundamentally is entirely reliant on their network of partner stores. People go shoe shopping. They care less and less about brand. They're caring more and more. The average consumer, right? There are all sorts of people that are very defensive over it. I am one of these people, to be clear. For shoes, I buy Hoka's, right? I'm a Hoka fan. Nike decided that they were going to bring in John Donahoe because they wanted to create a good D2C brand. They wanted to cut costs. They wanted to cut out the middleman, their partner stores, and they wanted to focus on digital growth. And this happened in 2019. This was right before the pandemic. This was prime time, right? This is not the way you run Nike. Nike is a cultural phenomenon. It's not a digital markets thing. And so there's a really interesting article written by Forbes. Basically, this is exactly what he did. Donahoe slashed sales teams in R&D and shifted products from Nike's retail partners to its own stores. Unsurprisingly, this boosted numbers in the short term. Soon after he took over as CEO, Nike struck gold when it revived a low-top sneaker from the 1980s with a black and white color scheme known as the Panda Dunk. Donahoe's reorganization of Nike followed a similar trajectory. He laid off hundreds of marketers with an intimate knowledge of Nike's customers, intending to replace them with data-driven insights. His shift from wholesale marketing through retailers to direct sales through Nike stores yielded market share to competitors who used that new presence to establish themselves as peers to the legendary swoosh. And Nike's financial performance soon became so bad that on June 28th, the release of Nike's earnings report triggered a 28% slide in the company's stock price, its worst single day of performance since its IPO in 1980. Donahoe inevitably responded with layoffs. Of course, the natural reaction. Nike's board finally woke up. They were asleep at the wheel, and they said, we need a change. And so they brought in Mr. Elliott Hill. If you don't know who Mr. Elliott Hill is, he is the president and CEO of Nike right now. He has worked at the company for 32 years in senior leadership positions all across Europe and North America, and he was responsible for helping grow the business to more than $39 billion. He retired in 2020, but the GOAT, the king, he was brought back in. They said, we need you, sir. Please run our company. Clearly, we do not know what is best for it. And so what he has done is he has implemented a turnaround plan for the company. It's going to be slow. It's going to be arduous. We're about a year into it. Regardless, the problems do not stop there. The problems are merely starting. They have a long, long hill to climb. Nike's sales fall 12% in Q4. This is from June 26 to 2025, so the middle of last year. Nike is not out of the woods yet, but CEO Elliott Hill expects the worst is behind it after an extended sales slump comp for the sneaker giant. Reported sales fell 12% year over year in the fourth quarter to $11.1 billion, Nike said on Thursday, a smaller drop than analysts anticipated and better than Hill's own estimates last quarter. Net income has shrunk in the past year to $211 million compared to $1.5 billion in 2024. This is important. This is what turnaround looks like. One of the big companies that I bet a lot on was a company called Bed Bath & Beyond. I bet that Bed Bath & Beyond would be able to figure themselves out. I bet that the new CEO that was coming in, he was going to lead cost cuttings. These are the lessons that you learn in investing. I really believe that when the new Bed Bath & Beyond CEO came in and he was like, okay, we're going to cut costs, we're going to build out our brands, and we're going to refocus on our stores and then also on digital transformation. Literally the exact same thing that John Donahoe was brought in to do to Nike. What happened was so interesting because the exact same thing happened at Bed Bath & Beyond that happened at Nike, where it worked really well in the beginning because there's this giant pull forward of profit and revenue, right? There's a turnaround plan. They're revitalizing the business. They're spending a ton of money early on to do all these different things. They're trying all these different things. They're bringing in a lot of customers because they're spending a ton of money, and everything looks great on paper. Maybe they even go back and they buy back shares. Maybe they start paying a dividend or whatever. In Bed Bath & Beyond's case, they did all of this. For the first year or so, things were looking pretty well. The problem is they just couldn't continue the momentum. The amount of money that they were spending was way more than they had, and eventually their debt caught up with them. Because I saw the writing on the wall, right? Bed Bath & Beyond was like, yeah, our revenue is up, but our profit is falling, and we don't know if we can continue this momentum into the future. And it turns out they just couldn't. What happens is, after the fall, you have to do this, and this is the hard thing to do. I tell that entire story to say this. Net income has shrunk in the past year to $211 million from 1.5. The reason why they lost $1.3 billion in net income is because they have to do product development. Their innovation is completely gone. It got completely gutted by the last CEO. And that's just what you get when you do cost cutting, especially in these culturally important companies. Eventually it catches up with you. And that's why, if you go back to here, John Donahoe took over like right around here, right around when the revenue was $45 billion. When he left, revenue was 51. That looks really impressive. But again, this is all just pulling forward all of their goodwill, but they're not able to sustain it because they've cut out what fundamentally makes their business good. And they did that through cost cutting. Now, granted, you can do cost cutting in effective ways. You cannot bring in someone new, especially someone who's unfamiliar with a business, in order to do cost cutting because you get stuff like this. This is the other really important thing. Both Nike's direct channels and wholesale revenue fell in the fourth quarter. Direct sales were down 14% to $4.4 billion, while wholesale fell 9% to $6.4 billion. Nike brought in the new CEO, and as part of cost cutting, they decided we're going to cut off all of our partners, and instead we're going to try and sell direct to the consumer. We're going to sell through our stores, and we're going to sell online. And so now, once all of that hasn't worked, now Nike's forced to go back to those partners and try and rebuild those relationships. In the wake of Nike's abandonment of its fundamental business structure and its abandonment of its selling partners, we've seen other brands rise up in its place, right? We've seen On Running come up. We've seen Saucony. You have Brooks. There's Hoka, which is one of my personal favorites. You have all of these different running shoe companies that are also coming up, and they're just making good shoes. Asics, for instance, is doing tremendously well. And so over the last couple of years, you could see this right here. This is the share price performance of a bunch of different other running companies. And you could see they're all wildly outperforming Nike. This falling asleep at the wheel has cost Nike dearly, not only in share price performance, but it's allowed competitors to come in and they've stolen that cultural relevance, which I don't know that Nike can get back. And if they can get it back, they're going to have to fight incredibly hard to do so. Now, obviously, Nike is not like strictly a running shoe brand. Comparing them to other running companies is not necessarily the best comparison in the world, but at the end of the day, Nike sells shoes. And so if these other companies are able to like walk through the door that Nike's left open, well, then Nike might not do so well in the future, because it doesn't matter how cheap your stock price is. If your company, especially a company like Nike, if it just can't remain culturally relevant, it doesn't matter. There's no like path forward in Nike's future that sees them coming back from this unless they can obtain cultural relevance again. If you look through the actual like earnings statements of Nike, you see sort of where the big problems are. North America, the change is up 9%, right? So their North American business is growing pretty well. Europe, Middle East, and Africa, only up 3%. $3.3 billion, the second largest portion of their business. And here's the big kicker, Greater China, accounting for only $1.4 billion worth of revenue, but it was one of their fastest growing consumer segments. Revenue's down 17%, down 13% in the last 6 months, but 17%, with footwear collapsing 21% and apparel collapsing another 6%. If you go throughout the rest of Asia Pacific and Latin America, you see another negative 4%. Converse has seen like a collapse as well, negative 30% in sales, just brutal stuff. Business Insider ran a story about Nike struggling to stay culturally relevant in China. Nike's CEO acknowledged a slump, saying it needs to reset its approach in China. Experts say Nike is struggling with cultural relevance as local brands connect with young consumers. Again, Nike's grip on China's sneaker market is slipping. Once a status symbol among Chinese consumers, analysts say it's increasingly losing cultural relevance, even as its products remain innovative. The core problem is a systemic cultural lag. Linda Yu, general manager of consultancy firm Red Ant Asia, told Business Insider, Nike needs to move beyond traditional sports marketing and genuinely understand and integrate into the cultural confidence, sense, and community belonging and lifestyle aspirations of China's younger generation. Local brands such as Anta and Li Ning have been capitalizing on this by creating culturally relevant marketing campaigns, product designs, and digital experiences that resonate with younger consumers. Of course, the geopolitical tensions between the US and China are also making it harder for Nike, encouraging consumers to favor domestic competitors. Rivals such as Lululemon and Adidas have seen growth in China as they've found ways to connect with shoppers there. So, clearly, American companies are able to come in and be somewhat culturally relevant in China. Nike just isn't able to do that. Like I said, Nike has a lot of problems right now. This is the shareholder letter for 2025. This is what the CEO, Elliot Hill, this is what he's telling his people. This is what he's saying. Like, this is what we want our brand to be. When I returned to Nike this fiscal year, I did so because I have what is called an irrational love for this company. From my first day back, it was clear to me that we need to get back to putting the athlete at the center of everything we do because athletes have always been the fuel of our brand. We want to ignite our winning culture, shape our brand for distinction, and accelerate our product portfolio, running, basketball, and global football. They want to elevate and grow the marketplace, and they want to win on the ground. They want to get back with these authentic relationships with consumers in the neighborhoods where they live and play. Also recently, Nike was in the news for something interesting that happened. A very prominent director at Nike and also the CEO, Elliot Hill himself, both made major buys of the company's stock. As you can see, one of the directors, also known as Tim Cook, also known as Tim Apple, the CEO of Apple, purchased about $3 million worth of Nike stock. And Elliot Hill himself also bought about $1 million worth of Nike stock. You have the CEO of Apple and the CEO of Nike itself both spending tremendous amounts of money to buy shares personally. And on this news, Nike climbed quite a bit. Another board member, Robert Swan, also bought 8,700 shares, which was about 25% more shares than he had. And so that's sort of where we're at today. Nike has a long way to go, but they've come a long way. The actions that the CEO is taking, I think, they're good first steps. Should you invest in Nike? Simple question. Hard to answer. I'm thinking it might be worth taking a small stake in Nike. The reason why I'm thinking very heavily about adding Nike to my portfolio is pretty simple. Nike, it seems as though they finally sort of woken up. The board of directors finally realized that Nike is not eBay or ServiceNow. They realized that they're not a digital first platform. They realized that the partners are really what makes the brand, and they're the most important part. And so they brought back Elliot Hill, who for 32 years has worked at the company, and they've implemented this turnaround strategy. Now, typically turnaround strategies don't go so well, but typically turnaround strategies are not done by, 30-year veterans of the company. It gives me some faith, especially considering, you also have the CEO of Apple on the board of directors at Nike. Now, as for whether this will all work, that remains to be seen. I think no matter what, Nike's going to be an interesting company to follow over the next couple of years. Like I said, they've got a long hill to climb. This competition, this isn't just going away. Nike has to figure out how to deal with this competition. If you enjoyed this video, be sure to subscribe. Also come hang out live too.